Hello, Investing Putts back with you again. It's my second video in 2 days. On a bit of a roll. Um, I've just been doing a lot of thinking lately and decided to put together some material. My main trade right now is a poor man's covered call, and I'm kind of studying it as an alternative to just owning shares of stock. Like, is there an edge, or is there a reduction in risk? So anyway, when you trade the poor man's covered call, there's really not common agreement on how you should select the strikes of the long call or the leap option or the short call. So in this video, I'm going to explore the effect of changing the delta of the short call on a SPY poor man's covered call position. The leap is a 400 strike with 110 days to expiration and a delta of 73. I'll test 3 short calls with 33 days to expiration. First, an at the money call, or minus 50 delta, a minus 73 delta, and a minus 33 delta call. The net delta of the spread varies from delta neutral to plus 43 directional, which is highly directional. Delta, which is highly directional. So I model both options using my Black-Scholes spreadsheet. I use a sticky delta model to estimate IV as time evolves and the underlying changes in price. So I'll show these graphs repeatedly, and so let me explain. The solid green line is the change in share price over the life of the short call. So in this case, SPY rises by $14 over those 33 days. The dotted blue curve is the net value of the spread, or the profit. So in this case, the spread increases by $9 in price, whereas the shares went up by 14. So by trading the spread, we've captured $9 of the $14 in profit that was available. So the dotted green line shows how much profit we have captured. So in this case, roughly 50 to 60%. Okay, so in this case, the short call is a 444 strike with a delta of minus 33. Since the leap has a delta of plus 73, the net delta is plus 40 when we open the spread. You can see that you might as well just hold the short call until expiration or close to it. The profit keeps increasing and the profit margin just keeps increasing all the way to expiration. Though typically I roll at 10 days to expiration. Now let's move on to a 435 strike, which is at the money or minus 50 delta. Net delta for the spread is 23 when we open it. The profit margin stabilizes at about 40%. So you might as well wait a while to roll this short call. Again, I'd roll this at 10 days, but it stays pretty profitable until the end. So finally, we show the result of selling a minus 73 delta 416 strike short call. The position is mildly profitable, but it does sort of lose profitability toward the end with, say, 15 days to go. So this is one where you could probably roll it with 10 or 15 days to go as well. Okay, so kind of more importantly for risk management, let's test these various choices of short call when the underlying declines. Here's the minus 33 delta short call when the price of the SPY decreases by about $14 over the term of the option. So the P&L starts bad and it just gets worse. But there's a short window in which to exit the trade, kind of where the profitability is not too bad. It's typically, this is when the short call has more than 20 delta remaining. So the positive theta effect decreases for you as that short call trends to 0 delta. And you can see that the profit curve just parallels the underline as the spread goes to 1 delta, basically, 100 delta. So for the 50 delta case, notice that we have a pretty large window in which to exit the trade. We don't lose much money on it really for the first 20 days. Through trial and error and some modeling, I've found that my preference is to roll the short call when it hits minus 35 delta, and that's proven to be pretty successful in managing downside risk. So now the delta neutral case, There's 74 delta short call is very interesting. I noticed that the P&L is actually positive, and it gets better all the way to expiration. Theta decay is working in our favor till the bitter end. But again, I would like to roll. I'd roll this at 10 days, just as almost as a matter of course, because weird things happen in the last 2 days to options that are difficult to model at times. Okay, so to sum up my analysis of the strike selection for the short leg of the poor man's covered call, I'll make another video looking at the selection of the delta of the long call. Anyway, the typical setup is the 30 delta short call. This is what everybody says you should do, but this is highly directional. It's essentially like owning 60 shares of long stock when the underlying rises and also when it falls. So when it's falling, you need to roll it quickly. I typically in this case would roll the short call at 20-25 delta, so pretty aggressively. I may be rolling within a day or two of opening the trade if it immediately goes down. Now my preference is to sell at the money or 50 delta calls. So when the underlying rises, it behaves roughly like 40 shares of stock, so it's still directional. I still like to be bullish on the shares to do this, but when the underlying drops, you do have time to roll it. There's a period of stability from when the short call goes from 50 delta down to about 35 delta, where you still have a lot of theta decay working in your favor. So I like to roll my at the money short call when it gets down to about 35 delta. So finally, if you sell, say, a 75 delta short call, you're now in a delta neutral trade. This isn't really a traditional poor man's covered call anymore. This trade is profitable when the underlying rises or when it falls to a degree. Now there's no urgent need to roll the short call, but again, I would typically roll it at 10 days to expiration. It's not a hugely profitable trade, but it could be worth considering when the market is trading sideways with low IV, and maybe doing it with some leverage. You could, your risk is mitigated. So yeah. Anyway, so I hope you found that useful. And again, I'll have another video coming out about how I select the delta of the leap or the long call part of the poor man's cover call. But anyway, until then, we'll see you later.